Antoine Lesné, you are portfolio strategist at State Street. The whole economic world is waiting for the Fed meeting in September. What do you expect of this meeting?
Well, I think there's a number of commentators that have been already expecting a number of, or at least one action, which may be a slow tapering of assets purchases. It is fair to say that the numbers coming out of the US have been slightly positive and should lead towards maybe a beginning of tapering. Whether the tapering is a big event or not is more the perception of the market rather than a full impact on the size of the tapering. Estimates go between 10 and $20 billion of tapering of those asset purchases, but there is still a lot of purchases going on in the fixed income markets by the Fed and in other asset classes, and we expect that this will probably be the outcome of the of this meeting, but for the moment everybody's waiting for Bernanke.
And how much do you think is this meeting already reflected by the financial markets?
We've seen a big jump in yields in May, June, a little bit of a backup back in July, and some, I would say, volatile times, but not too much of a move. A bit of a increase in yield in this month. A lot I would say, based on the amount of potential tapering, a lot has already been priced in, but we continue to anticipate increased volatility in the fixed income market because of this policy uncertainty and how much it will be interpreted by the markets, and what will be the phase or the pace of this tapering in the coming months and going forward in the years to come.
US Treasuries have lost value over the past few months. Are these bond investments actually still an option?
Well, if you start to invest in them, obviously the yield is more interesting than it was a few months ago. There is still a lot of interest rate risk, so you're not being compensated a lot for an interest rate move at the moment. So I would say US Treasuries are always an investment in one's portfolio if you want to prepare for a potential downturn in the market or a surprise in the market. And there may be many reasons in the next months to come, whether they come from Europe or maybe from disappointing economic news to old Treasuries. But if you're looking for yield, this is not the most attractive exposure at the moment.
In the present economic environment, what's your opinion about fixed income investment against stocks, for example?
Well, it's a very difficult question to ask to a fixed income skewed strategist, I would say. Valuation in equities could look quite high from where we see in terms of growth potential. Earnings per share have increased, obviously, but they may be a bit high. We tend to say within our group that European valuations tend to be a bit better than the US ones. And in the fixed income markets, we tend to favor credit over duration or carry over duration. So we tend to favor corporate bond investments in the short end of the curve to limit the potential impact of increased treasury yields.
Situations in many emerging markets are difficult at the moment. How much will they fall further?
Will they fall further? It's very much linked to, and you may mean because of local currency movements. I mean, if you see an increase in US Treasury yields, it tends to have a negative impact on the currencies of emerging markets. We've seen that with Brazil, especially over the past few months. There may be some continued volatility ahead in the coming months for emerging markets. In the long term, we still value local currency emerging market debt from sovereigns, where a number of them are actually in a phase of convergence towards being more developed, and we see that as a potential good investment in the long run. But you have to be able to wear your seatbelt and weather the volatility, I would say.
Antoine Lesné, thank you for the interview.